Research as well. Good morning. Thank you so much for making time and speaking with ET now. Well,
Thank
we
you.
have seen this massive bout of volatility across the world, plus the headlines coming in from UK, China, etc. Given the fact that we are tracking a lot, do you think this massive volatility that we have seen and the flip-flop moves that we have seen intraday as well is likely to continue for the rest of the year, Edward?
I think so. We've had a tremendous shock. We've gone from an environment of the past several years where interest rates around the world were close to zero. In some cases, they were actually negative. And then all of a sudden, we see that inflation made a remarkable rebound over the past year, forcing central bankers to raise interest rates. And they've been raising them very quickly. Particularly the Federal Reserve Bank has been doing perhaps the most tightening, and that's why the dollar is so strong. So the world's in a shock from an interest rate shock and from a dollar shock, and that's creating a lot of volatility in financial markets around the world, which will probably continue. But keep in mind, volatility works both ways. We can have some really bad down days, but as we've seen of late, we can also have some very dramatic up days.
Edward, I'm wondering what you're making of Xi Jinping's commentary coming in from the Congress. Some stern comments, especially when it comes to Hong Kong, although we haven't seen any policy disruption so far, something that the market was anticipating and fearing, to be honest.
Well, there's certainly no surprise. The leadership in China is going to remain the same. The policy is going to remain the same. It's a very authoritarian approach to running a country. It's certainly territorially expansive in terms of what they've already done in Hong Kong and what they're talking about doing in Taiwan. It's going to present a real challenge. I don't think it's a good place for investors, given that the rule of law is not being kept in that country. And I think global investors have to look elsewhere. I think they found some good places to invest. The United States is doing extremely well with the strong dollar. A lot of money's actually been coming into our bond market. And I think India has also benefited quite a bit from global investors recognizing that China is a hostile place for investors.
Oh, well, yes, India has been at least one island where a lot of FIIs have looked to. But the other trade that has been working this year, Edward, is the dollar strength, right? It's currently trading at 113. Do you think this is likely to continue, or at some point of time there would be a reversal in terms of early pivot from the central bankers, and that might impact the dollar index? What's your take?
Well, I'm sure you're all familiar with that word TINA, T-I-N-A. There is no alternative. That was sort of the rallying cry for the bull market before the bear market, where the idea was that there's no alternative to stocks, particularly U.S. stocks. Now I'd like to propose a new word, TINAC, T-I-N-A-C. There is no alternative country. For global investors looking for investing in a developed economy, I think the United States stands out as TINAC. And so, yes, I do think the dollar is going to remain strong. We've got a Cold War that's getting hotter between the United States and China. We have a proxy war between NATO and Russia in Ukraine. It's a very dangerous world out there, and global investors, I think, are going to continue to come to the United States, and that would argue for a still stronger dollar.
Edward, but is there a way that you can say that perhaps the US markets have bottomed out? Are you seeing any indications of that?
Everybody's looking for a bottom, and it's very frustrating. It hasn't happened. I think the big problem investors have is they're used to situations where the Federal Reserve lowers interest rates because of a financial crisis or because of slowdown in the economy. And when the Fed lowers interest rates, that's when we usually have been making bottoms for the past few decades. We had the so-called Fed put. Well, the Fed put is no longer operating, quite the opposite. The Fed is being forced to raise interest rates because of inflation. So I think we'll probably make a bottom once the market perceives that we're getting very close to a peak in the federal funds rate. And the Fed has been tightening very quickly. We've already seen 300 basis point increase in the Fed funds rate since March, and now they're talking about and likely to do 75 basis points on the federal funds rate in early November and another 75 basis points in mid-December, and that might be it. I think that the next rate hike in early November may start to make a bottom in the market as the market anticipates that we're getting closer to the terminal federal funds rate.
Right. Edward, great having you on the show today. Thank you so much, and we always look forward to your insights.
Thank you very much.